Okay, chapter three, financial statements analysis and financial models. So we're gonna do a lot of the things that you hopefully were, did during Finance 3301 when we're gonna go delve deeper into financial statement analysis, financial ratio analysis, the DuPont identity, and so forth. Then we'll introduce some new ratios and talk about those as we move forward. So key concepts and skills here. Know how to standardize financial statements for comparison purposes. Know how to compute and interpret important financial ratios. Be able to develop a financial plan using the percentage of sales approach. Understand how capital structure and dividend policies affect a firm's ability to grow. Chapter outline. So financial statements analysis, ratio analysis, DuPont identity, financial models, external financing and growth, and then we'll finish up talking about the financial planning models specifically. So financial statement analysis. So standardized statements will make it easier for us to compare financial information, particularly as a firm grows, or even just over time, we can look at prior years and calculate ratios and see how the firm's doing and get a pretty good idea. They're also useful for comparing companies of different sizes. We have, for example, we're comparing ourselves to a competitor that might be significantly smaller or larger. The ratios allow us to do that effectively. Common size balance sheet. We compute all accounts as a percent of total assets. A lot of times you'll see percentages on a financial statement. Those are common size balance sheets. Common size income statements compute all line items as a percentage of sales. Ratio analysis. So ratios allow us to better comparison over time for on and between companies. When you look at a ratio, ask yourself what are we trying, how is it computed, and what's the information is it giving us, and why are we interested in this? So what's the unit of measurement? What does it indicate? What would the company have to do to improve its ratios? So we have 5 categories of financial ratios. First are short-term solvency or liquidity ratios. Most people just refer to them as liquidity ratios. Long-term solvency or financial leverage ratios. Most people refer to them as financial leverage ratios. Then next is asset management or turnover ratios. I typically call them asset management ratios, and profitability ratios, and market value ratios. So those are the 5 categories. Hopefully you're at least familiar with these. So the first one's liquidity ratios. The current ratio is current assets divided by current liabilities. If we are using our fictitious corporation, if we went back to the balance sheet of our U.S. Corp from the book, they would have $708 million of current assets divided by $540 million of current liabilities. That's 1.31 times. For the most part, with the current ratio, you look for something greater than 1. Indicates that the company, for the most part, should be able to meet its obligations. But sometimes we have to delve deeper. The next ratio is a quick ratio. the quick ratio, we take out inventory. So it's just the current ratio, but we subtract out inventory from the current assets. The reason being, as I mentioned previously, inventory can be illiquid. So then my favorite example is iPhone 6 versus the iPhone 11. So if Apple had a warehouse full of iPhone 6s, then those are probably not worth very much. They considering that I was looking at a new phone and Apple offered me $10 to return my iPhone 6. So but on the other hand, the iPhone 11s would probably be very valuable. So it depends. The value of those assets depends on their liquidity, their ability to be sold and utilized. So, you know, in this case, we subtract out the inventory, and our quick ratio is 0.53 times. This is potentially an indication that the company, if that inventory is illiquid, the company could have trouble meeting its current obligations. Next is the cash ratio. So just cash divided by current liabilities. So in this case, the cash ratio is 98 million. The cash is 98 million divided by the 540 million of current liability, or 0.18 times. This is another indication that the company could have trouble meeting its current obligations. So the company is utilizing its money elsewhere. But there is obviously some potential for default. We're going to start the next lecture calculating leverage ratios, leverage ratios.